There are only three things that can move the market: the macro, the fundamental, and the technical. Technical simply obey the former two, and often the macro leads the fundamentals. So with economic data weakening and yields falling, is that good for stocks? And when does soft data become outright bad data? Especially as the JOLT data came in today very soft. Part of the reason why this economy is still standing is because people have jobs and can find jobs very easily. What happens when that crutch breaks? Today, we'll discuss that and the upcoming non-farms print. BofA see inline data, but Goldman paint a little bit more of a grim picture. So today, we uncover the truth. We'll also be taking a look at June seasonality, sector analysis, and why this chart should be taken with a grain of salt. So will markets continue the rally, or should we hedge our bets? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. A very mixed day of trade here today. A lot of it had to do with the rate cut situation, implied rate cuts, and the Fed's policy rate, but overall a fairly green day, especially when the mega caps go out, put out a big day. Look at Nvidia up 1.25%. Microsoft, Apple participate, Google and Meta net positive here in comm services, as well as Amazon. When you have some of these big names put out, it's going to be a fairly positive day in the market across the board. We also saw outperformance here today in rate sensitive sectors, particularly real estate, looking really good on this front. Commodity driven sectors, because yields fell, commodities also fell, didn't do too good. Energy fell, basic materials was pretty negative on the day, but it was mixed in almost every other sector. There were winners in industrials, there were losers. Same is true here for financials. We saw some of the bigger names, the banks take it on the chin, but like credit services, MasterCard, American Express, Visa, not too bad in that regard. But overall, the best performing sector was actually real estate. I mean, this is the sector that's going to gain the most from rates falling. Then we saw actually staples up 0.87%, software 0.042%, sort of software rebounding off last week's horrid price action, still down on the week overall. And then comm services, because Google put out a pretty good day, and then healthcare technology up 0.29, 0.21%. So really today it was like growth and rate sensitive sectors that really did gain on the back of, well, what was weaker jobs data, right? And that was the reason why rates pulled back in a very significant way. The SPY gained 0.11%, and then every other sector actually underperformed the SPY. We saw discretionary did gain, but then utilities lost. Same with industrials, semiconductors, financials, energy, home builders, regional banks, home construction, GDX, and XME. In fact, commodity-driven sectors, metals, minings, and GDX really had a rough day because commodities fell in a very big way. So much so that silver actually broke this key level of support here at $30. It was really a key level. We've broken below, and if this is to be used as resistance and we do move further down in silver, there is a number of key levels we can look to. The first being here at the 28 level, and then below that we're probably looking very close to the 26.5 level. So silver up here looked very constructive, but now it does look like it wants to pull back. But if it does go ahead and regain the $30 level, yes, it will be a lower low, then we can actually go see these higher levels. So very crucial here for silver. Same with gold, down 1%, but the price chart looking far more constructive. But let's actually just dive into the market as a whole. So we had a very mixed day of trade, like I showed you on the heat map, but the RSP was actually down 0.3%. Here today, the IWM down 1.29%. Same with mid caps and small caps. So really it was large sized and captured most of the gains and held the market up. We saw the S&P 500 up 0.15%, the Nasdaq 0.29%, but we're seeing a little bit of upbeat action here in the after hours, both RSP and IWM. The big thing definitely was yields. I mean, last week, everybody was freaking out because we broke above the 4.5% mark. I said it was a bit of a fake out. We are now moving lower. The 10-year yield was down 1.14% today. And the reason why we've actually moved lower has to actually do with economic data. We've had pretty soft data in the last week, and that is why we peaked out here at 4.5, and then yields have actually come down in a significant way. And we're actually at this very critical level here at the 4.3 level. This is a critical level because if we actually zoom out, we can see that we use it as resistance right here. Here, resistance turns support, and now below the 4.3 level opens up levels to as far low as the 3.7% range for the 10-year yield. But there's very key levels that we want to go break first on the way down. It's not going to be an elevator down, it's going to be a stair step down. And the levels we'll be looking at first and foremost is actually the 4.18% level right here, and that's if we do go ahead and break below. But I do think that if we break this 4.3 level, we're going to see 4.18, 4.2 very quickly. So that's the first level, and then from there we can just look to the 4% level as the next level of support. These will provide strong support levels and resistance if we do go ahead and break them. But what you really want to look at is not necessarily the yield. You actually want to look at the bonds, because that's how you take advantage of falling yield. And if we actually have a look at TLT, we actually saw some very, very interesting things on the chart. Pulled back, we formed like this low right here. This is actually where I said to take TLT longs in the live stream at about the $88 mark. We then actually had a rally from this level, pulled back. We've now formed a higher low, and we've actually broken above this high. Very constructive. We can then go ahead and look at the 95, 96, 98, and $100 levels as the next targets here, unless this level is broken. But even if this level does break, I do think we're going to find proper support again at the $88 mark. I think, this $88 mark right here for bonds is probably going to be the low of bonds for 2024. That being said, had you put your money into TLT, you'd still be down about 5.66%. Maybe you would have collected about a percentage point worth of dividends, but you'd still be down for the year. But it does look like TLT is getting ready to make its next move. But let's actually dive into the S&P 500 and just look at the day's trade today. So 5250 level is offering a very, very strong level of support and base right here. We do know that the 5250 level is now our gamma flip zone. It's actually the 5240, but we'll say 5250 just for greater confluence. Now, we've seen some big buying below the 5250 area. Market makers really want us above this area, but we've also seen some fairly stagnant price action here above. And I think what the market is trying to do is price in what's actually going to happen with the NFP. We know BofA think that the NFP is going to be slightly upbeat. We know Goldman think it's going to come in cooler than expected. So I think the market's probably going to trade at this range into the NFP print, and then the market will assess the data from there. But looking at today as to what we actually did, we saw some very interesting price action, right? So we actually did gap down here in the S&P 500, and then we actually made our way all the way down to a low. And here at midday, this is sort of when we pivoted, and we saw quite a steep rally all the way to as high as nearly 5,300 intraday. And then we actually came down, piled a lot of the losses, but we closed the day at 52.91. All of this was actually dependent on the rate cut situation, especially with 10-year yields falling 1.4% here on the day. That really did support equity prices. And right now, what the markets are trying to do is find a balance between yields coming down, supporting equity prices, and cooler economic data affecting overall economic growth. So where does this leave us with price action tomorrow? Now, I reiterate exactly what I said yesterday. We want to be buyers of dips at this 5250 zone, 40 points above it now. If you did miss it, probably a bit late to enter the trade, but we want to be buyers of dips at 5250. We want to look to the 5350 and 5400 levels now as support, because that's where the call gamma resistance is. Ideally, 5250 and 5200 will offer us strong support, and this is where we want to take profits with these trades. So we are officially back in positive gamma. So buy dips, sell rips, and look to the 5400 into this June OPEX. I think we should get there, provided that some of these data points behave themselves and yields do fall below this 4.3% mark. So guys, diving into earnings, I had a look at Bath Body and Works, bit of a dumpster fire with its earnings today. Hewlett Packard HP was actually up about 17% or 16% here in the after hours. We're going to dive a little bit deeper here into CrowdStrike. So CrowdStrike actually put out fantastic earnings. Beats across the board. They beat on revenue, margins, EPS, free cash flow, as well as recurring annual revenue. However, they did miss here on billings, and that's why the stock actually fell about 4 or 5% initially when they released these earnings. However, you'd actually have a look at the guides. CrowdStrike actually did guide up for the second quarter 2024, guiding up on revenue, as well as margin and earnings per share. And then they also increased their full 2025 guidance to $3.994 billion against the consensus 3.975, and again, guided up on the EPS. So this was a double beat on the revenue and EPS side, and then a guide up. And the stock did fall initially, as you can see, about 7.88%, but it rebounded significantly off the lows, up 15.88%. And if we actually have a look from the closing price at the highs, it was up about 7% here on the day, and up about 6.69% here in the after hours. So the market definitely liked the earnings. It's just that they were waiting for the guidance. They dropped the earnings and they released the guidance in the actual earnings call. So great earnings here from CrowdStrike, should help the overall cybersecurity space. Stocks like Fortinet are also up in the after hours, Palo Alto too, and actually software as a whole is up 0.29% here in the after hours. So really, really upbeat day for software, and continuing to see this price action here in after hours thanks to CrowdStrike. So now guys, looking at earnings expectations, you can see that Mag 7 earnings are expected to decelerate, while the other 493 earnings are expected to pick up. Now, you can see this very, very easily obviously here on the chart, Mag 7 earnings are expected to decelerate when the other S&P 493 are expected to accelerate. However, we've seen a drastic change. I was showing you guys this chart pretty much at the start of the year, and at the end of 2025, Q4, Q3, Q2, we actually did expect the 493 to outpace the Mag 7 in growth. That is simply not the case anymore, and we do expect the Mag 7 to continue to grow well above the other 493. And this mostly has to do with Tesla. We can actually see that Tesla's growth expectations ever since their last quarter has actually increased significantly. We've actually seen a lot of up revisions from negative into positive territory, both here on the revenue side and the earnings side. It doesn't show it on this chart, but this right here is revenue and this right here is EPS growth. And before last quarter, these numbers right here were actually negative growth for the rest of 2024, the third and fourth quarter, but now they are actually positive. And that is part of the reason why we're seeing Magnificent 7 earnings outpace the other 493, because Tesla is contributing a lot of earnings growth, as you can see here, when previously it was negative, flat, or well below these numbers, especially with the negative sentiment that was surrounding Tesla. Now, this is mostly just revenue figures, but when it comes to a stock like Tesla, the market places a lot of weight on the revenue figure, especially in a company, I wouldn't say as early as Tesla, but the EV space is relatively new compared to almost most industries. So this is really what the street is looking at in terms of growth. The truth is earnings growth can come later as a result. But it's not just Tesla that we're seeing upward revisions for. We're seeing upward earnings revisions here in the S&P 500, Europe, Japan, as well as emerging markets as a whole. We could see ever since April for emerging markets, as well as probably since January, we've seen upward revisions for almost every single market, especially the Tokyo region. We've actually seen immense upward revisions since here 2023 April. It's part of the reason why Japan has actually been the best performing sector probably in the last 6 to 9 months. That being said, if earnings revisions are flat and or going up, that's very, very positive for equities, because most of the time earnings revisions actually move down. Analysts set an expectation, and we normally actually get downward revisions of about 4% from that expectation when we get to earnings time. So for example, if earnings are expected to come in at $100, normally we can expect a $96 downward revision. So to actually see upward revisions here in the last 4 to 5 months, very, very upbeat, very, very positive for the market as a whole. And that is part of the reason why we've actually rallied here for most of 2024. But that doesn't mean all indices are made equal. This is the trailing 12-month return contribution, essentially looking at dividend contribution, PE contribution, earnings contribution, and then the total return. Now, if we actually look at the Japanese market, the TOPIX has returned about 32%. We can actually see here that the majority of that has actually been from EPS growth and then multiple growth, this dark blue area, and then some of it from a dividend contribution. We see roughly the same situation here with the S&P 500, not quite as much earnings growth contribution, but roughly 50-50 between earnings contribution and PE contribution. It gets a little bit more grim when it comes to the rest of the world, but this actually tends to happen prior to an earnings driven cycle. What normally happens is we see multiples expand and then the earnings set to follow that. And just because the European market here is rallying mostly because of multiple expansion, what this is telling us is that European markets are expecting stellar earnings 2025 and beyond, and do expect this chart in the stock 600 to look very 50-50 come this time next year. But that's really about it. We can actually see here in emerging markets, as well as the global market ex-Japan, we can see that a lot of the return contribution from the rallies that we have seen in these markets have actually been from the earnings side. So very, very healthy market action. It's far better to have an earnings driven rally over a multiple expansion rally, because there's just far less speculation involved. These are actual earnings contributing to actual price growth, and with earnings constantly being revised up, do expect this to continue. Now, the ACWI, the All Country World Index, the forward PE is 15.5. Now, that actually represents an expected return of 12.8%. Very, very interesting. This is obviously the market cap weighted index return, but do take this figure with a grain of salt. Generally speaking, when the global expected return for the MSCI ACWI is around the 12 to 15% mark, the actual average return in the next 12 months tends to be 2.5%. While While valuations do look compelling, if the earnings don't go ahead to meet those expectations, we can actually get subpar returns. Now, diving into some historic data that's far more reliable than this is the S&P 500 performance after we've had 4 up months, then 1 down month, then 1 up month, and the returns we can expect over the next quarter. Now here in 2023, we've actually returned about 11% in the S&P 500. The first 4 months returned 4.4%, 1.59%, 5.17%, and 3.1%. So this was December, January, February, March. Then here in April, we were down 4.71%, and now in May up 4.8%. And what are the subsequent returns we can expect for the next 3 months? Now here in month 1, can actually expect 0.89% average return, 25 wins, 11 losses. In the second month, 22 and 14, 0.99% average return. And then in month 3, 2.17% average return for a full quarter. Total return on average 4.03%, 31 wins, 5 losses. And you can have a look at the peak drawdown, almost always in the low to mid single digits, except for 2 outlier occasions right here and right here. So very, very positive stats for the bulls is expected. Now that's not to go without volatility. We definitely can get volatility, particularly in the first and second months, but that should just be a dip buying opportunity because we do get outsized returns for the full quarter. Now we are in a bull market, and let's actually look at past bull markets and the stocks and sectors that led in those versus what's leading right now. So bear markets almost always resulted in a change of leadership. So after we've had a bear market, so these gray lines right here, we can actually see that we normally did have a change in leadership. For example, from 57 to 65, it was tech and comm services, very interesting. Then in 62 to 68, it was comm services and real estate. Those are the 2 leading sectors. Then here in 65 to 72, we had real estate and healthcare. They were the leaders. And then from 1970 to 1980, it was healthcare and energy, and so on and so on. Now let's actually go back to the early 2000s. We can actually see that from about 1990 all the way to 2008, the leaders was actually technology and energy stocks. And then from 2002 into 2020, a very long bull market, it was roughly the same, except it was energy and technology stocks that were leading. And now in this new bull market, which we go from about 2008 all the way to where we are right now, we can actually see that it's technology and cyclicals X technology. So stuff like semiconductors, financials, discretionary, those are the stocks that are leading the way forward. And then we do have our laggards, stuff like utilities, materials, staples, and they are simply lagging here behind. But in 2022, we actually entered a new bull market, and I wonder what that is going to look like 5, 10, 15 years down the track. We can definitely say that it's going to be technology leading for sure. Tech's going to be in there, but it just depends what are the other sectors as well. Is it going to be discretionary? Is it going to be the same, tech and cyclicals X tech, or are we going to see drastic outperformance in sectors like utilities or energy based on the AI trade? But the key point to take away from this is that no 2 bull markets and no 2 bear markets are the same, and you always have to be proactive with your portfolios. Now, guys, yesterday we got some pretty shocking manufacturing data. Go ahead and check out yesterday's video. If you didn't, we talk about it at length there. But as a result, the Fed's GDP now fell to 1.8% from where it was pretty much close to 2.8%. That was a drastic fall. And now I don't think the manufacturing data accounted for all of this. I think part of the reason actually had to do with NFP. To understand how NFP can drastically affect the Fed's GDP now, we actually have to look at how the GDP now is forecast. So reading from the top, the growth rate of the real gross domestic product, GDP, is a key indicator for economic activity, but the official estimate is released with a delay. But our GDP Now forecasting model provides a nowcast of the official estimate prior to its release by estimating GDP growth using a methodology similar to the one used by the US Bureau of Economic Analysis. GDP Now is not an official forecast of the Atlanta Fed. Rather, it is best viewed as a running estimate of real GDP growth based on available economic data for the current measured quarter. There's no subjective adjustments made to GDP Now. The estimate is solely based on the mathematical results of the model. So I think along with the manufacturing data we got yesterday, the Fed probably got access to some of the data points in the NFP, and this led to the drastic drop in this model in the last few days. Now, should we be concerned? Because the strength and resilience in the US economy we've seen since 2021 has been because people have jobs and the disposable income of those jobs is growing at a higher pace than the actual rate of inflation. Goldman Sachs have a note here for us, and let's go ahead and read. They say, "We expect a below consensus 160,000 increase in May payrolls this week. We expect private payrolls to rise 140,000, government to add 20k. Big data measures indicate below normal pace of job creation, and our layoff tracker has risen a bit from low levels. We expect two offsetting special factors. The seasonal factors are likely to expect too much during the spring hiring season in a tight labor market with a low hiring rate, but the longer than usual May payroll month should provide a boost. We forecast a 0.25% increase in average hourly earnings, which incorporates a monthly 2 basis point drag from calendar effects and would lower the year-on-year rate by 5 basis points to 3.87%. We expect the unemployment rate to remain at 3.9% and the participation rate, which has fully recovered from its pre-pandemic demographic trend, to remain at 62.7%. So Goldman expecting a little bit softer data. Maybe that's what the Fed's looking at, and that's also why we saw such a huge drop in the Fed's GDP now for the second quarter 2024. That being said, Goldman do expect a little bit softer employment data, so we should be prepared for a bit of volatility towards the end of the week. And we're actually seeing that in the options market. Right now, the options market is pricing in a 0.95% move on this NFP print. While not the biggest we've ever seen, definitely a significant move, and this is to the upside or the downside. So do expect volatility this Friday towards the end of the week. Guys, let's dive into Gamma. So not a lot has changed except for one major thing. The Gamma flip zone, the HVL, is now at 52.40. That's a level we've been looking at, not quite 52.40, but we've been talking about the 52.50 level as a strong area of support and resistance. And now the Gamma flip zone is right at about that level. A little bit lower, but it does act as a little bit of a buffer being at the 52.40 level. I mean, if the market now does pull towards this 52.40, 5200 area where the put support is currently situated, I think we're definitely going to find strong support here in the market, but there is risks because if we do go below this area, this is then going to act as a strong resistance leading up into it. However, we are still in positive Gamma, and as long as we're above the 5200 and the 52.40 level especially, we want to be buyers of dips, sellers of rips, looking to the 5400 area towards June OPEX. The game plan will change if we do get below the 5200 area, but as it is right now, there's no need to worry, no need to stress. Buy dips, sell rips until something tangibly changes, and that change happens below the 5200 area. Having said that, if we do experience a little bit of volatility, it's actually completely normal. S&P 500 seasonality here in June, we actually do tend to see quite sideways action for pretty much the entire month. Yes, there is a bit of volatility to the upside as well as the downside, but then you look at it in totality, really we trade in this range up until the 21st, 22nd, 23rd, and we actually do get quite a steep pullback that we can see as early as the 16th, 17th of June, and then we normally put a bottom here around the 27th, 28th, where we normally par a little bit of the month's losses. We do finish positive for the month, up 0.1%, but vastly off the highs of the month. So again, if we do trade downward, potentially sideways here in June, completely normal with seasonality. And in fact, a little bit of weakness in June is completely normal. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.